Okay, we're going to start. Good morning. Welcome back, everyone. This is our Paycheck Protection Program webinar series. We've had obviously a handful of them previously with the first round of PPP, and we're moving in obviously with the second round here as we'll get into more details with that. My name is Tony LaNasa. I'm a principal with HW&Co out of our Columbus office. I manage the office in Columbus. We also have Jim Horkey, who is a principal in our Cleveland office. You should know us pretty well by now. With that, Jim is going to get into the agenda here and a few items on an overview.
All right, hello everybody. Tony mentioned we're in Cleveland today. We're actually in our West Side office, which is located in Middleburg Heights, Ohio. Thanks for coming down, Tony. Appreciate it. And here we are today after a big night last night. I'm sure everybody's a little bit tired, but it was March 27, 2020 that the original CARES Act was passed, and what a crazy time that was. I don't know how many of these seminars we've done, but we've done quite a few, and we're hopeful that there won't be the level of confusion that came with the original CARES Act. And what we're calling the new CARES Act is really part of this Consolidated Appropriations Act that was actually passed on December 27th of 2020. And I think we're off to a great start for 2021. There's so much stuff in this bill. We're not going to be able to cover all of it, but we're going to cover what we think is important to our business clients today. And some things we'll get into detail, some things we'll only touch on. But we're going to do a little overview after this. Tony's going to talk about the provisions of the new bill that still impact the original payroll protection program, what we're calling our first draw loans. There are some things that will benefit our first draw. If you received a first draw. I'm going to talk then about probably what a lot of you are here for, and is how do you qualify for the PPP2, or what we're calling what they're calling the second draw. Then Tony's going to get into some of the technical calculations with the second draw, and then there's also if that's all you stayed for, make sure you stay at least as well for the employee retention credit. This is going to be really a big benefit for a lot of the businesses that were most impacted by the pandemic. And then I'm going to talk about that, and then Tony's going to get into a number of the other provisions, at least to try to make you aware of them at the end. So we have a lot for an hour. So next one there, T. So the Consolidated Appropriations Act, to say the least, it's a very big bill. Actually, the longest bill ever passed by Congress. 2.3 trillion in total. Go to the next one, Tony. But our focus is really going to be on 325 billion that's set aside for small business. However, we are going to touch on some of the tax provisions as well that aren't part of the 325 billion. And to put it into perspective, the original CARES Act came out, it was 349 billion, and that was really available to almost any business that could justify that they were in an uncertain time. And then that money went pretty fast, and then it increased to 659 billion. And out of that money, it all actually was not spent. I believe roughly 585 billion of the entire combined amount was actually provided to small businesses. So this bill is much more targeted, and so so we're thinking anyway that the 325 billion will be an appropriate amount, and that it won't be as much of a concern that the funds are going to run out. So next one there, Tony. So go through a little timeline here. Once again, it was signed on 12/27, so this is all very new. Then the Treasury, SBA put out what they call interim final rules, IRFs. They put 2 of them out on January the 6th. The first one really just takes, the original CARES Act, and then it was after the original CARES Act, all these rules just kept coming out and coming out. This really consolidates them all together. And then the second IRF really outlines the key difference between the first draw and then summarizes all the new rules as they relate to the second draw PPP loans. If you want to read these actually aren't hard. They aren't bad reads. Trying to read the actual bill is crazy. I tried it. It's very difficult, but these interim final rules are actually pretty easy to read, and the best place to find them is you just go on ustreasury.org, and there's a link to them right on the front page. You can't miss it. Then on January 8th, the SBA has started to issue forms. Primarily what they've issued are lender applications. Both applications for the businesses, and then there's actually business applications and then lender applications. There are not yet. There's going to be new forgiveness forms that are going to come out because the forgiveness process has now changed. Those forms do not exist yet. However, as far as the banks, I feel bad for my banker friends because really, even though there are paper applications, most of the banks put together their own portals and their own interpretations of the applications. So I'm sure today they are scrambling to get those updated. Initially when I put this together, we figured that this second week of January was our best guess. Actually, it's today. Theoretically, the first applications are being accepted today, but only because this is more targeted. The applications initially are only going to be allowed to community financial institutions, really designated for small and minority businesses. And then later on, possibly 2 days later, which would be Wednesday, it should open up to a larger group. Really, our advice for today is if you think you got a chance at these after we go through some of this, you should reach out to your bank. And but the program is going to stay open until March 31st of 2021. So there theoretically is plenty of time. So thanks, Tony. You want to get into the first meaty section here?
All right. So provisions related to the Appropriations Act and changes to the original PPP loan. One of the big tickets here, and I'm sure hopefully everyone listening has heard this, that there is deductibility now of all the expenses that are applied for forgiveness of the loan. So that's huge for all businesses for the most part, which is great. We'll dig in a little more into that in the next slide. There's simplified forgiveness for loans 150,000 or less. So we have some details on that as well in the slide. The Appropriations Act allowed additional funds, additional costs that could be included for forgiveness. And you can see them there under the third bullet. We'll talk about those and what kind of what that means for businesses overall with the additional costs that are included now. The original PPP, there was a lot of businesses that originally got a PPP, and for some reason they paid it back to the lender without going through the whole forgiveness and so forth. In the Appropriations Act, you can reapply if you think you qualify either for the original loan or again for the PPP2. So you can reapply at this point, and there's a process to do that with your lender. So if anyone listening today did apply and receive funds, but then paid it directly back immediately, there might be a consideration there. Borrowers that received a loan, but then guidance changed after, which potentially would increase their loan funding. You can actually modify your loan now. So you would go through your lender And there's a process for that as well, where you go through and you would ask for the additional funds that you should have gotten because of changing in guidance, okay? So if there's any one of you that potentially has that, you may want to talk to your lender about that.
Tony, that's one of the key ones was, partnerships. So partnerships that applied early on, there was a lot of confusion, and a lot of times the actual partners comp didn't get counted, and then that got corrected. And there wasn't a way to go back and fix that, but now there is.
Right. And then the Act confirms the ability to elect a covered period between the 8 and 24 weeks. Previously, it was 8 or 24 weeks, but guidance did say that, well, you could use, a period in between the weeks. Now, the Act actually says that now, so it just confirms that. And then one of the key items here, for those that did receive an EIDL advance, that's the Economic Injury Disaster Loans. They got an advance up to $10,000. They repealed the provision to reduce the EIDL advance with the PPP forgiveness amount. So now going forward, and this also applies for the original PPP, you do not reduce your PPP forgiveness from the EIDL advance that you receive, which is good. So just dig into the deductibility here. As we mentioned, the actual expenses that you're using for the forgiveness now are deductible for tax purposes. Good news for all of us. Now, also good news is, as well as the tax basis is increased related to the amounts as well. So there's no reduction potentially of the forgiveness that's provided by the PPP on your tax basis related to that, which is good as well. And then a good thing about this, this applies to all PPP, phase 1, phase 2, first draw, second draw, any of that. It applies to all the PPP loans. If you do have the PowerPoint, the PDF, the PowerPoint, you can click on that last bullet. It's a direct link to the revenue ruling, IRS revenue ruling for it that was issued on January 16th. If you want to read through that, it's just a couple pages. Simplified loan forgiveness for loans 150 or less. You can see here that the form is not out yet for this. They do have the 3508S form for loans 50,000 or less, but they do not have this form for simplified forgiveness for 150 or less. So you'll have to wait for that. I think the consideration for that is, if you do have a loan less than 150, you'll probably want to wait for this form to come out. Not much information that you have to include. Obviously, you have to retain all the records that you have. And then the second-time borrowers that have to have that reduction with 25% or more of revenue or gross receipts, you'll probably have to provide some information to the lender on that. It either will be when you apply for the loan or when you apply for loan forgiveness, most likely probably at the back end. Some of the additional costs here, I'll just kind of go through really quickly. Covered operational expenditures. This really relates to a lot of businesses that had to go remote or had to go virtual. So that it's going towards the cost related to the software, cloud computing, any of that type of thing where you actually had to pivot. A lot of businesses had to pivot and move off site. So that's going towards that. The covered property damage, you can see if there's any damage and cost related to the vandalism and looting potentially in 2020. You can include that as well for qualifying costs. Covered supplier costs. This is a very broad category. You can see that it's talking about supplier of goods, so any costs related to that. But it also mentions essential for the business, which, if you think about it, I would think a lot of the goods that you're purchasing for a business is essential. So it's a very broad category. Now, you do have to have a contract or order or purchase order before the covered period starts, or if there are foods and things like that, and at that time, then it would be either before or during the covered period that you'd have to have some sort of contract in place. Next, the worker protection expenditures. This is operating or capital expenditures. It relates to the business adapting to any of the provisions related to the guidance under HHS, CDC, and others. You can see some of the examples here. The major thing here with restaurants and fast food is if you're adapting your drive-through windows and things like that. If you're adding barriers as far as in-person dining in and things like that as well. You can see that too. This is only applies to residential real property and intangible property, or it does not apply to residential real property or intangible property. Moving on to eligibility, and Jim's going to take this section.
All right, this is what a lot of you may have, be listening for. There's a number of things you have to qualify for to be able to receive a second draw loan. First off, you can't receive the shuttered venue operator grant. Tony's going to touch on that at the very end. However, if you're a theater or a concert venue or a museum, there's a separate program for you, and it may be better ultimately than the second draw PPP loan. The second thing is you can't employ more than 300 employees, and that was 500 previously. Now it's 300, and there's a number of exceptions that we're not going to get into, but the same exceptions that applied to the original CARES Act PPP1 draws are still out there. And the big one is the third item here. Your gross receipts, during the first, second, third, or fourth quarters of 2020 you have to show a 25% decrease for one of those quarters when you compare to the same quarter in 2019. As far as we know, it's going to be calendar based, and that's the way the law reads right now. We've had some questions on what about fiscal year companies, and it's not been addressed, so stay tuned there. They've got a simplified method. If you were in business for all 4 quarters of 2019 and your 2020 in total is 25% less, you don't have to, you can just use the whole year to kind of simplify the process. But you'll have to provide tax returns to substantiate that, and which is an odd requirement, considering if you're doing a quarter, you don't have to provide tax returns. But there's a different set of calculations if you were not in business for the entire year of 2019. And that's really great because, imagine you opened a brand new business in, January, February 2020. There was really nothing for you because you didn't meet the requirement of having been in business. So now there's now a way for you to go back, and you can do it by a number of comparison methods depending on when you actually started business. As long as you were in operation at least by February 15th, 2020, there's a good chance that you're going to qualify for some second draw funds if you can justify it. And you have to have used the entire first PPP loan amount. So that's a requirement. I already mentioned you have to be in business as of February 15th, 2020. You still have to make the same certification of economic uncertainty that you had to make under the original first draw PPP loan. And just to make you aware, for farmers and ranchers who there's different rules for them versus that are more related to income than to revenues. And then also, while seasonal employers getting this, different treatment in their calculations isn't new, they've now done a little better job of quantifying that. So I'm not going to get into the details, but it makes a little bit more sense now. Really the first item here is if you were eligible before as a business, you're probably still eligible. They didn't exclude anybody that was previously eligible. So that's going to be, you have to be in business. A large number of our not-for-profits are, if you were eligible before, you still are. Really, one of the items that they added are 501c6 entities, which I told my partner Tony that no one knows what those are, but those are your chambers of commerce. What else, Tony? Chamber of Commerce, travel bureaus, yeah, those kind of things. You just can't be overly involved in lobbying if you are one of those type entities. And then they opened it up to certain news organizations and housing co-ops. They have a number of entities that, if you're one of these entities, it doesn't matter. You can apply. You're going to be ineligible, and with a very few exceptions. I think for some of the restaurants, there's a few exceptions, but if you're publicly traded company or a hedge fund or a private equity firm, the thinking is you have other access to other funds, so therefore you can't access these PPP2 funds. If you're in bankruptcy, you can't apply. These businesses in code section 120.110, those are your passive type entities, real estate holding companies, investment companies, things like that, where you really wouldn't have a lot of payroll anyway. If your primary business is political or lobbying, you're not going to be able to apply. And then there's a number of special rules for affiliations with, if you have affiliations with either China or Hong Kong. We don't think it precludes anybody that has a China subsidiary, but none of those costs are going to be able to be used, and that's not new. However, if you're in any way controlled by a foreign entity, you may have some issues. And then, if a lot of people have household employees, those aren't going to qualify.
Hey, Jim, we have a question related to, there was a business that used the SBA size standards previously, and with the PPP2, could they use those same standards?
Yeah, that's what I was saying earlier. It's the size standards. Those are very complicated, and a lot of times the companies that did rely on the size standards actually got their attorneys involved. But yeah, we don't see anything in here offhand that says that would not still apply.
Okay.
And then really this is targeted funding, and the biggest target is NAIC S code 72, which is hotels and restaurants. Those are the hardest hit and should have the least amount of issue with showing a 25% revenue reduction for a quarter. And I think for the vast majority of our hotel and restaurant clients, they can show for the entire year they're down more than 25%. So this is really for them, and they're going to get a number of waivers that make it a little bit easier, and then they're going to get a favorable calculation, which Tony's going to go over that.
So just getting into some of the details here, the calculations and so forth. So with the new phase 2 PPP2, the maximum loan is $2 million. Now that is for second draw borrowers. If you're new to it and you didn't get an original loan, that's going to be a $10 million, just like the original loan PPP program as well. So just remember that. Now there is this kind of caveat where if you're considered this single
in here.
Can't hear us? Can you hear us? Now we can. Okay. All right. So apologize that. So again, the maximum is $2 million. There's a cap of $4 million if you're considered this single corporate group, which is it's more of like a parent-sub relationship. So just remember that. The calculation of the actual loan itself is no different for most businesses. It's the 2.5 months average annual payroll. Now for the businesses that are under the NAIC S code 72, which Jim was talking about, with the hotels and restaurants and others, they can actually qualify for 3.5 times months average payroll. So that's good. They get extra money related to their business. And I know we talked about the measurement period. If you could use 2019, you could actually use 2020 or like a trailing 12-month period as well. So in actuality, if you use 2019 previously, you could use the same period and get the same loan amount for this second phase.
Good. Tony, I don't know if you touch on it in the future, but for most, I think 2019 may be still be their highest number, and it's my understanding you don't have to resubmit that gets the details.
Right. Yeah, you don't have to, you know, it's obviously it's up to the lender, but if you're using the same lender, they already have that information. You would not have to submit that information again to them as far as payroll costs. Okay. Now this is the big thing, right? Gross receipts, revenue. What does it mean for businesses that need to calculate this and qualify for that 25% or more reduction? So, you know, if you look at the guidance, it talks about all revenue in, you know, whatever form it is. And it talks about, you know, what kind of method you use. Well, you use whatever method you're using, accounting method you're using for your books. You know, if you're using cash, and that's how you report it, then you use cash. If you're using accrual, then you're going to use accrual based on the calculation for gross receipts and revenue. Okay? You can see some of the examples of the revenue. You know, it does include interest and dividends, rents, things like that. Now, it also includes, it gets reduced by returns and allowances. Okay? So again, you have to take a look at, you know, uncollectability potentially. If there is some uncollectability of receipts of your AR, you may want to take a look at that and reduce some of your revenues based on that potentially. So just something to think about and consider as you're kind of going through these calculations. The revenue does not include net capital gains or losses and affiliate revenue. Okay, and that's specifically included. It's included in the Act. It does state that. It also states that the original PPP loan forgiveness is not included as well. So if you got an original loan, you do not include that in income for these purposes of the calculation of gross receipts. Now, we've gotten lots of questions with other relief, you know, with healthcare providers receiving a lot of the provider relief funds and coronavirus relief funds, other pandemic relief, you know, state, local relief, even the workers' comp rebates. Do you include those? Well, it does not specifically state anywhere about that. We're hoping there's guidance that comes out very soon here that kind of tells us if we should include it. Now, you know, if you think about it, the PPP original loan forgiveness is not included, and a lot of this other relief is similar, where you're using it for, you know, COVID-related expenses, you're using it for payroll, keeping people on payroll, you're using it for PPE, and so forth like that. So I guess we would recommend not including it at this point, but I would think if there's no guidance that does come out, these are significant dollars, obviously, you'll want to run this by your lender or your bank and probably include it in the application that you are not including these funds, just so it's transparent to the bank and lender that you're not including these funds in 2020. Okay, so make sure you're doing that, keep, you know, being transparent with that to make sure. Now, we're hoping guidance comes out, but we'll see. The definition of receipts is this CFR. Again, if you have the PDF downloaded, you can just click on that link and get to the definition of the receipts under the SBA definition and kind of read through that. It's a couple pages as well. The forgiveness piece didn't really change. It added those newly costs, obviously, that we talked about. The minimum payroll amount of that 60% is the same, no difference there. And Jim's going to talk about the employee retention credits later. So, you know, there might be a strategy here where I know initially we were saying, you know, maybe you just show all payroll as loan forgiveness and move on, but there might be a strategy here not to do that anymore. So Jim's going to get into that in a few minutes here. And then again, as I mentioned before, just reminding everyone about the simplified forgiveness of the loans of $150,000 or less. Documentation, again, didn't really change very much, especially if you're using the same figures as you did with the first loan, the first phase. You know, if you have loans over $150,000, you're going to have to show the support for that revenue decline, right? If you're getting a second loan and you have that decline of 25% or more, you're going to have to show that somehow. That could be tax returns. Obviously, I know 2020 tax returns aren't filed yet, obviously, so you'll have to probably provide some sort of substantiation, you know, internal financial statements, things like that to the lender that you're showing that decline occurred. We talked about the loans less than $150,000. We think that you will have to provide support, but probably at the back end when you ask for a loan forgiveness. The process here, as Jim mentioned, there are forms out there. They're loaded on the GoToWebinar handout screen here as well. If you're going back and trying to increase the original loan, you can see sort of the process here of that, going to your lender and doing that as well. Certifications, again, you can see the certifications here, very similar to the previous, other than, certifying that you have that decline of 25% of gross receipts and so forth. Now, employee retention credit, Jim's going to go through this.
All right. Well, when this, new bill came out, one of the things that it took us a while to say, wow, this is huge. But when the original CARES Act came out, they included an employee retention credit. I think it was part of the original CARES Act, or at least it was put out around that time. And while that seemed at first like a big deal, there was a provision in the act that said if you took a PPP loan, then you couldn't get the employee retention credit. Well, we said, well, that's dumb. Who would even care about that? And hardly ever looked at it. I don't know that we have any clients that even applied for it or could have applied for it. So, so the big major change here is that you now can receive both the employee retention credit and the PPP loan, and that's retroactive back to 2020. So, for a lot of our clients, they're actually going to be able to now go back to 2020 and calculate this credit. It's actually a payroll tax credit. And so if you were able to get this for 2020, you'll amend your 941 and you'll get a credit toward the taxes paid, and it would be a refundable credit. So we'll go through a number of definitions here, and then I'm going to try to simplify this, but I can tell you this is very complicated. It actually gave me a headache when I tried to figure it out the first time. It was so complicated. So some of our tax people have been really studying this, and we think we're on top of it. And however, the forms have not come out yet. The old forms are still there, but the new forms have not come out. So to be eligible, you have to meet one of these two criteria. The first criteria is you have to have your business fully or partially suspended due to orders from the federal or state government limiting commerce, travel, or group meetings due to COVID. Well, if you kind of go back in time, if you remember Sunday, March 22nd, that's when Governor DeWine, in essence, closed down all non-essential businesses. And then those businesses were, allowed to reopen over time depending on the business. So, gyms reopened at a different time than, say, manufacturers. There's a lot of confusion with that. But the key is if you meet that first one, you had to still, did you still continue to pay your employees? And I know a lot of our clients initially, furloughed or laid off a number of their employees. However, a lot of our clients, even though they did, they continued to pay health insurance for their laid off employees. And those health insurance costs actually would count. So that's one criteria. And a lot of this depends on size, which I'm going to get into next. Or is for 2020, you have to be able to show a decline during a calendar quarter of 50% or more compared to 2019. Well, for some of our restaurant clients, that's not going to be hard. And, and then the credit now continues forward through the first two quarters of 2021, but you're still comparing back to 2019. I wish I would have put it on the exhibit, but for 2021, it's a little bit easier. If your business is still down and you have a 20% decline, say in the first quarter of 2021, you compare that to the first quarter of 2019. If you're 20% down, you're going to be eligible for this credit. Some more definitions, like when I'm talking about qualified wages, if you're a large employer, it's wages, that's going to be wages paid to employees not providing services. For small employers, qualifying wages are going to be wages that are paid whether the employee continued to provide services or not. When we say qualified wages, that also includes the health insurance, which I mentioned. And here's where it gets tricky, to give you something to think about. And this is where, we're going to have to get some spreadsheets going on some of these, but you can't double dip. So, when you're looking at forgiveness on your original PPP1 loan, you had to spend at least 60% on wages, okay? The same wages that are eligible for these credits. Now, you could spend 100% on wages, and a lot of our clients did. They really actually spent, they spent the money across many categories. However, it was for simplifying purposes, they just said, okay, I spent the entire amount on wages. That's easier to file that way, and that's what they did. And for some that haven't filed yet, you still have a choice. So what I'm getting at is, this is a credit on wages. It may, for some, be better to go back and say, well, we really spent, 60% on wages and 40% on all these new other categories. So the next tab is my attempt to simplify this. And it's not as simple as I'd like, but first let's look at 2020, the column under 2020. So it would be equal to 50% of the first 10,000 of qualified wages. Now, which could be different if you're large or small employer. The employee can receive up to $5,000. It's up to $5,000 per employee. So if you had $10,000, if you paid $10,000 to an employee, the credit is $5,000. For 2020, we're talking about wages, qualified wages that were paid from March 12th through December 31st, 2020. So it's a one-time calculation. So it's that first 10,000 only. If you qualify, if you don't qualify, if we're talking about wages where you still had services provided, the gross receipt test is a 50% decline in a quarter-to-quarter basis. And remember, for small employers, it's 100 full-time employees or less to be considered small. So that's, for a lot of our clients, that's not going to be hard, but we have a lot, if you're over 100, then you're going to have to have paid people to not provide services. Now, 2021, it's loosened up, okay, and it's expanded. So now the credit's equal to 70% of the first 10,000, and it's subject to the first and second quarter of 2021. So it's two different calculations. So you can receive up to $7,000 per full-time employee per quarter if you paid them enough, okay? So, it actually, the law says January 1 through July 1, though I don't know why it wouldn't have been June 30th, because it's the first quarter, second quarter. And then now we're talking about a 20% decline versus a 50% decline on a quarter-to-quarter basis. So as we're now into 2021, if you're down 20% at the end of the first quarter compared to the end of the first quarter of 2019, now I think you've got a credit to consider, okay? And then the definition of a small employer is now a lot easier to meet. So it's 500 full-time employees or less. If you're under 500 or less, you don't have to worry about being closed. You only have to meet the criteria that you've got a gross receipt decline. And as I said before, and it's very complicated, but I hope as you're looking at this, I hope you're thinking, boy, I might be able to qualify for this. And if so, give us a call or talk to your tax advisor, as our tax people are getting their arms around this as we speak.
And then just other reliefs that we wanted to mention. There's a couple of good things that happened here with the Act. The extension of the subsidy of the SBA loans, just existing 7A loans through the SBA. Those were being subsidized by the SBA. They extended that now for 3 more months beginning in February 21. So they capped it at $9,000 per month. So again, I know some of my clients are taking advantage of that. So that was something good to hear and see. Also, I know we mentioned about the EIDL advances. You know, they do have funding for that in the Appropriations Act for additional advances through EIDL. Now you do need the reduction in revenue of 30% or more, and it does mention an 8-week period, but I don't believe it defines what that is. So if this is something that you could qualify for, you may want to take advantage of it. The grant amount, the advance amount is $10,000. So it's not, you know, it's pretty, you know, significant dollars for businesses. So if this is something that you qualify for, you'll want to either take a look at it on the SBA website, or talk to your HW advisor to see if you do qualify. And then Jim talked about the shuttered revenue operator grants and all that. The one key thing I wanted to mention here is these funds likely will be exhausted very quickly, because these types of businesses really need funding to keep people employed. So just if you are under that category, make sure you're getting in the front end here related to some of the lenders potentially applying for those funds.
Yeah, we're getting our arms around that now. For instance, let's say we have a client and they're a brewery, and they also offer, entertainment 3-4 days a week. Are they an entertainment venue, or are they a brewery? We're trying to get our arms around this. So if you think you might qualify for this, let us know, as we're working on it, as we all speak here.
And then I know this, I'm not sure if any clients use this Main Street loan program offered through the Federal Reserve. It was offered through December 31 of 20 now, and now it's been terminated. So now it can come back at some point here in 21, but right now no one can apply for that loan program at this point. Other provisions, I'm sure everyone has heard, with the unemployment, that's been extended to $300 per week. Supplement has been extended through March 14. The individual stimulus, the $600 payments per eligible individual is there as well. You can see some of the phase outs. I don't think there's any changes with that other than the dollar amount there with the new act. The eviction moratorium is being extended through the end of this month. There's a lot of tax extenders, which you see a lot of that every year with these tax extenders and things like that. Now they included a lot of that information within this act. So there's a bunch of things in there. And then, a couple quick things, some of the tax provisions, with businesses that have, business meals, they are offering 100% deduction now for business meals specific to food and beverage offered by restaurants. And that is for 21 and 22, year 21 and year 22. So it's not going retro, but it would be for year 21 and 22. So, something to think about for your businesses. If you do have these business meals, you can have 100% deduction compared to 50% reduction previously.
Yeah, Tony, I think the official or unofficial name of that is the 3 martini lunch deduction.
There you go. And then the charitable deductions, the $300 that was mentioned previously, that is still there. But for married filing jointly, they increased it to $600 for 21 now. So $300 is still applies for 2020, but now there's a $600 deduction. That's for non-itemizers, right? The above the line deduction for those for 21 would be $600 now. Yeah, so now we have a few minutes here just to kind of go through some questions. Hopefully we have some answers.
So we don't have frequently asked questions yet, but we're working on it.
Well, there's lots of questions in here that I see. So it says, what if an entity maintains books on a cash basis throughout the year and then converts it to accrual basis for annual audited financial statements? That's a good question.
It's a good question. While this isn't an official answer, I think you would use your accrual basis. You'd probably use your accrual basis if that's your official way you calculate. If you do your tax returns on a cash basis, because we have a lot of clients that do that, I'm going to say you'd probably use your cash basis revenue, because that's what the IRS, that's what the federal government's going to match up to.
Yeah, I think really it's kind of whatever external reporting you have. So for tax purposes, if you do report on a cash basis, most likely you use cash basis. And if you do a report on accrual, then you may most likely would report on an accrual basis. Jim, this is for you. ERC can be used 2020 first quarter wages.
Well, yeah, that's if you meet the criteria for 2021 with your revenues being down, the credit would be calculated that credit would be calculated on your first quarter 2021 wages on a per employee basis.
Is the ERC only applicable if you continued paying employees while shut down?
Well, it depends on your size, and that's where this gets really complicated. So if you meet the size requirements, well, the credit itself is based on wages. So if you laid everybody off and didn't pay any health insurance, didn't pay any wages, then there'd be nothing to calculate the credit on. However, for where this is going to be a really large benefit is if you meet the criteria to have to apply the credit, especially whether they provided services or not. So if your employees, you kept them on, they continued to work, but you meet the criteria, that's where this is going to be a huge benefit. But for many of our clients, even if you don't meet that and you were closed down for some period, to the extent you paid out payments still to your employees during that period, we think you're going to be able to get some kind of a credit.
And so please define payroll costs. No change in payroll costs, so it would be your gross payroll during the period that you're using, with the loan period, either 19, 20, 12 trailing months. It would just be the gross payroll that you're paying out. Now it's again, there's no change. So there's a max cap of $100,000 per employee on an annual basis. You do not include that. So make sure you're doing that there's a cap on that as well. So that's good. What else we got? Getting a lot of questions on method of use. Hopefully, potentially, we may get some clarification on that with the SBA. You have any comments, Jim, as I'm looking through some of these?
No, and as always, if you sent us a question, if we don't think it was addressed, we'll reach out to you. Don't be shy. You can email or call Tony or I or your normal HW company rep. Tony, you got any more questions?
Yeah, we have a business got the original loan and they have not applied for loan forgiveness yet. Is there a deadline? Well, there really is not a deadline. However, in the guidance, it does say that the principal and interest will be required to be paid 10 months after the covered period ends. So obviously we're still within that. We're still in January, either way at this point. But just remember that principal and interest will be required to be paid 10 months after your covered period ends. So make sure that you consider that.
In general, we've been telling our clients all along not to rush to ask for forgiveness, not for any particularly political reason, but we felt like ultimately the criteria would become streamlined and simplified with time, and that's been the case. We had no way to know this employee retention credit would actually come into play. So we're hopeful that none of our clients will be negatively impacted by that, but for sure the clients that did not apply for forgiveness yet, if you think that's going to only benefit you on the ability to maximize that credit.
We got a question here. This is a nonprofit that receives donations individual corporate donation. Do you include that in cash receipts? I believe you would include that in cash receipts. It's your overall gross receipts of an organization. It is noon. I'd like to thank Jim and his participation. If you do want other information, we are on LinkedIn, we're on Facebook, we're on Twitter. You can follow us on any of those platforms. You can also contact either one of us if you have questions. Any questions that were posted that we did not answer, we'll try to get back to you this week on and try to provide some clarification on that.
Okay, well, thanks for attending our webinar, and we'll probably never have a webinar again on a Monday after a Browns playoff game. So,
all right, thanks everyone.
Take care.